Why hasn't the economy crashed?
Okay, Susan Powder. So today we are going to demystify why the US stock market seems to be still throwing confetti despite Trump's tariff tantrums. The economy's defied expectations. There appears to be a strong consumer, modest inflation, GDP is still chugging away.
Did Trump get it up? Can Trump keep it up? That's what we're answering today on Queer Money episode number 603.
So let's release our frustrations.
I don't know that there's enough time on the internet to let us release our frustrations.
Or enough alcohol for this conversation,
Exactly.
right?
So, but this question has come up quite a bit, especially due to the recent firing of the BLS statistician. So we're going to dive into some of the numbers, why we haven't actually seen the cataclysmic fall in the stock market and in the economy that was initially predicted. In summary, it's going to be a slow burn for us, but we'll talk about the details that we're not necessarily headed in the right direction. Meanwhile, though, if you're watching on YouTube, please share in the comments how you're feeling about the economy, the stock market, and your financial security overall. What's the feeling like for you? That'll help us give us more information for more information to cover in the future.
And we're going to get a little bit more economical data intensive in this episode, just because we think it's important for all of us to have an understanding of what is going on when we make these kinds of decisions for our portfolios, for our financial future, for our retirement. All of these kinds of things give us not only ammunition for responding back to some people in our lives who we probably should be cutting out, but also being able to understand when we're having conversations about the economy.
Yeah, so let's touch on some of the numbers.
Yeah, so the first thing we want to talk about is the economic curtain call. And really what we're talking about here is what is going on with the GDP and consumer backbone. GDP in the second quarter, it was just announced the week that we're recording this, that there was a solid 3% annualized growth of GDP in Q2 of 2025. So that's for April, May, and June, right? So how is it that then those 3 months we had so much growth? And that is
the tariffs started in, the announcement was in April, right? Liberation Day.
Right, exactly. And so why is that? Especially when you look back to what happened in Q1. In Q1, the GDP was actually only up 0.3%.
And it was down 0.3%.
And okay, so yeah, you're right. There was a significant gap here. And why is that the case? Well, there's a number of factors that are at play here, but one of the biggest impacts as to why that number looks so good in the second quarter is the impact of imports. And so what we're really seeing here is that when GDP is calculated, they subtract out imports from that number to make sure that it's an accurate number.
What's happening here locally and not being influenced by countries around the world.
Right. So for example, if I buy parts from all over the world and I bring them together and I build a product and I sell that product for $10, but it costs me $6 to buy all those parts, our GDP shouldn't say that I created a $10 product because I didn't create all $10 of that product. $6 of that product came from outside of the US. So I only added $4 worth of value. So when the GDP numbers are reported, they subtract out that $6 or all of those imports to make sure to give an accurate representation. Well, what happened in the first quarter? We know that companies were preparing for the tariffs, so they were buying a lot of imports. They were bringing a lot of product onshore, which meant that there was a huge number subtracted from the GDP, and that's why it was so low. But then in the second quarter, they stopped buying products. We saw all those stories about how...
Because they started to go up in prices.
Right, exactly. So that is why we see a huge shift and why everyone is talking about how great the GDP is, when in reality, it's just because we weren't buying as much imports as we normally would.
Right, and how this might be affecting viewers and listeners is that core inflation is still hanging out at around 2.9%, up a little bit, but not nearly as egregious as everyone was fearing. But for whatever reason, half the country thinks it's better now than it was under Biden. but we're not actually seeing real inflation skyrocketing yet because it hasn't quite yet hit the economy, which we'll elaborate here in a little bit. We're starting to see some red flags that we're about to feel it, but it hasn't quite. We're not quite feeling the full brunt of that yet.
Right. We know that a lot of product was brought onshore in the first quarter, and those companies they don't have a reason to pass on tariffs because there weren't tariffs charged on those products. So that's part of the reason why there are so many items still onshore that are being sold in stores today that don't have those tariffs on them, and that's why we haven't seen the kind of inflation that we are expecting, but we are seeing it creep in. Things like coffee have already shot up.
Yeah. Ours is going from what, $10 to $14 a pound in the last couple of weeks?
From 12 to 14 for organic and from 10 to 12 for non-organic. So about a 20 to 25% increase.
And unfortunately, a lot of economists include as well, are still talking about the consumer is still resilient, which if we find to be a nebulous term, right? Because right now, real wages have not kept up with inflation since the 1970s. By and large, the resiliency of the American consumer, the middle class mostly, is our access to credit. So It creates this illusion of resiliency that doesn't actually exist. And in fact, this week alone, a Bank of America economist shared on CNBC that income growth is happening. And that's affecting the large numbers, the headline number that's reported in the news. But not surprising, the growth is happening at the top, and it's really starting to slow at the bottom. So it's another sign that headwinds are coming, and we want to start preparing ourselves for that. The other thing is, so obviously Trump has implemented tariffs. We haven't seen this kind of a spike in tariffs since the 1930s, yet the economy hasn't collapsed. And as we're going to elaborate here, a lot of this is sort of we're starting to see the lagging effects of that policy now. But as I shared on an Instagram post yesterday, in fact, why haven't we seen the effects of the tariffs quite yet? Well, Trump announced on Liberation Day that all these tariffs were going to go in and exactly when they were going to be implemented and how much different countries were going to be charged. But then, has been widely ridiculed with this taco trading strategy, Trump always chickens out. Tariffs have been on again, off again, on again, off again. So economists who used Liberation Day as the beginning point for when we can expect to see the economy and the stock market start to crash, well, they didn't know that they were going to go on again, off again, on again, off again. And the analogy I used in that reel was, if I am going to cook you a spaghetti dinner, I can reasonably estimate that it's going to take me about 20 to 30 minutes to cook you that spaghetti dinner with boiling my water and simmering my meat and simmering my sauce and boiling some frozen vegetables. But if somebody comes along with their tiny little hands and starts putting their hands all over my knobs, turning them on and again, off again, up and down, too hot, too cold, I can't reasonably predict when dinner will be ready because of all these variables that I'm not used to managing. And that's kind of the effects for economists is that, well, the variables keep changing. So making a prediction is really challenging, if not impossible. But then, of course, we have a government that likes to say, we'll see the economists are wrong again.
Yeah.
Right? Exactly.
So why, though, is the stock market booming? Well, there's a number of reasons for that. One of the primary reasons is big tech continues to spend big.
Yeah.
Firms like Apple and Amazon, Microsoft, Meta, NVIDIA, a lot of these companies are spending a lot of money. They started this spending years ago and are continuing to do it because of the demand for AI infrastructure, especially. We're seeing these deals that Trump is announcing. A lot of these are ones that many of these companies had already planned on, building these huge data centers, investing billions of dollars. Well, they're going ahead with this. And because of that, the market and the analysis of the market, many people are looking ahead and saying, once all of this technology comes online, it's going to provide a massive amount of productivity to the economy, especially to many people in their everyday jobs. And they're thinking that that kind of productivity is going to be have a positive effect on earnings.
Yeah, so big business are infusing big capital into the economy. Also, on top of that, over the last several years, we've seen a huge increase in the number of individual investors getting into the stock market. And one of the ways one of the most popular ways that many people get into the stock market is by investing in index funds. So they're not necessarily trading in individual stocks. So every time that there's, a shock to the system, i.e., Trump opens his mouth, the stock market doesn't necessarily fall into the hellhole because these investors are sort of in for the long term, right? They're not day trading index mutual funds or even index ETFs. It's kind of a forced buy and hold strategy. So that kind of helps provide some stability in the market despite what's happening on in the economy or in Washington.
And I will say that because of that, also more and more money is going to the companies at the top end of the indexes, those what are often called the Mag 7 or the top performing companies in the S&P 500. Those companies have an overshadowing effect on the overall market, the whole market. And so they are, in a sense, kind of pulling everything up because as people invest into the S&P 500, then more and more money has to be invested into those companies. Whether or not they're actually doing really well or not, they're going to continue to invest in those companies.
Right. And then on top of that, I mean, we've all heard about the taco trading. At this point, basically, traders don't necessarily trust Trump. He's just a lot of hot air. And so he might say something that actually means something down the road, but even a broken clock is right twice a day, right? So for the most part, people are just kind of saying, yeah, tariffs will come, tariffs won't come. We don't know exactly when. And he continues to prove them right because last week, didn't he just extend out the time frame for the Chinese tariffs?
Yeah.
Again, for another 90 days. So, and I think part of that is because of all the countries he's most concerned about, it's China.
Right.
Because, I mean, they're kind of becoming the next superpower if we don't watch ourselves.
Right. And we did see the market crash in April. And part of the reason we did see that is because what is considered to be a leading indicator versus a lagging indicator. A leading indicator is something that looks forward, is kind of predictive. And so in April, there were a lot of people that were predicting these trades will hit the market and that will cause people to stop spending. It could drive us into recession. And so lots of people sold out of the market. And then lagging indicators is actually the true data, the data like we're seeing in the GDP numbers that actually says this is what happens.
The revised data that gets you fired.
Right. So here's a gay analogy as to what a leading indicator versus a lagging indicator is. A leading indicator might be like someone projecting that Georges would win Drag Race All Stars 10 because she came in fourth on season 9. A lagging indicator might be like finding out that Ginger Minj actually won because the results came in.
Economists note the shocks are fading, replaced by a focus on earnings and optimism, especially in the tech and AI sectors. So sort of take all that into account as you're doing your investing, but also as you're doing your retirement planning. So on the ground reality, how are everyday people like us, like you, how are we all feeling? Well, inflation isn't skyrocketing, but it is slowly creeping up. It hasn't gotten better from day one. We haven't seen an improvement in everything. In fact, I just went grocery shopping today, and all the prices of almost everything. There's a jar of garlic that we used to get. That once upon a time that used to be like that was like $4.99. And that was a couple years ago. And even more recently, during the Biden administration, it was about $6-7. It is now $10, $9.99 exactly at the store, and so that's increased significantly. Job growth is starting to slow. There was a sharp drop in hiring in July, down 73,000 jobs, and previous months were revised down. Now we don't know what to expect, right? Because we fire people who don't give us the data that we like.
And I think it's important for those of you who are not paying attention to this. This is a really important thing. When the job numbers came out earlier this month, Erica
McAntuffer.
Yeah, thank you.
The
commissioner of the Bureau of Labor Statistics was fired because someone didn't like the numbers that were announced. And so this is scary because when numbers come out and you fire somebody because of what the numbers say, it basically says that you're okay with manipulating the numbers to get what you want. And that's what's really scary, I think, for a lot of economists, a lot of analysts, A lot of people in the financial services industry now are saying, do we trust the numbers that come out anymore because someone fears for their job or because someone has been put in place because they're going to report the right numbers?
I think the good thing is that we always have the government data, but there are lots of different universities and other organizations around the country that produce similar data. So if there isn't some alignment, they don't necessarily ever really mirror each other ever because they kind of calculate a little bit differently. But if one is a complete outlier relative to all the others, then you kind of know maybe somebody's not really giving you the honest feedback. But something to keep in mind here, I know there's a lot of talk about lowering interest rates. The Fed right now is juggling sort of always has two priorities, but specifically right now, they're trying to tame inflation without crashing employment, right? So that's kind of a tough space to be, especially in this economy. And so on top of that, Jerome Powell's also dealing with all the things from Trump, which, kudos to him.
Yes.
So forecasts point to a slowdown, perhaps flat growth maybe in the second half of 2025, which may suggest a soft landing, not necessarily a crash. And if that does actually happen, we need to all send thank you cards to Jerome Powell because he's flying this very erratic plane.
Right.
But there are cracks showing in the economy, as were recently shared last week, the week prior to the publication of this episode. And that's through the consumer price index as well as the producer price index. We're starting to see a slight uptick in the consumer price index and even a bigger, but still somewhat slight uptick in the producer price index. And so those are leading indicators for what consumers overall and the economy overall will eventually feel. So if producers are starting to see an uptick in expenses, well, who do the producers transfer those costs onto? It's the consumers. So we're likely going to see, if things go the way everybody's predicting, we're likely going to see both those numbers increasing, and you're really going to start to feel it in your wallet.
Right.
It's really going to start to hurt.
I think one of the important things to point out about that producer price index going up by 0.9% in 1 month, annualized, that's going to be over 10%. The last time 1 month was up that much was all the way back, I think it was in May of 2020. So it was either May of 2020 or in 2022,
right.
but it was during the time period when companies were passing on those price increases due to the slowdown or the problems that were happening in the
supply chain.
Thank you. What was happening with the supply chain, those price increases, that demand for goods that weren't there, they were passing those prices on to all of us.
Yeah. So the bottom line is that the U.S. economy is doing better than expected because of the resilient, and I put resilient in quotations, consumer, tech muscle, which that's actually totally legit, and investor optimism in holding the line. Most spending comes from the top 40% right now, and the rest is being covered by credit card debt from the resilient consumer. That can't last forever. And so we definitely need to have wages go up. But of course, every time wages start to go up, we start to see inflation go up. So that makes things a little bit more challenging. But keep your eye twitching. Tariffs, soft job numbers, the Fed decision could all throw everything sideways. Your Queer Money takeaway from this episode is markets may sparkle now, but stack your cash smartly. Don't get blinded by the glitter.
Right.
And don't get glitter in your eye. That really hurts.
Yeah. So how are you feeling about this economy? How are you feeling about the stock market and your own financial security? Make sure you share that in the comments. And don't forget to grab your free Happy Gay retirement calculator and start planning your own fabulous retirement.
Then next week, join us when we cover the 5 best places in Malta to retire as an LGBTQ plus person. We've had a lot of requests for Malta, so we're excited to dive into the numbers there and share our results. And then in 2 weeks, we're going to actually share the nitty gritty of how exactly David and I are able to retire at the ages of 51 and 54. Who do you think is 51 and who do you think is 54?
And maybe not just all of the nitty gritty. We're going to focus on a couple of big factors that really have helped us.
Big numbers again?
Mm-hmm.
Big data. If you love this episode, please remember to like, subscribe, set notifications, and share it with your friends who also want to retire fabulously. And until next time,
stay fabulous.
If you're still afraid about a crashing economy, maybe check out this video here on what to do and what not to do when the markets crash.